The coronavirus pandemic has definitely shed further light on the need for local governments to really support and care for low-income community members in their community that are really bearing the brunt of COVID's health and economic crises, in addition to the structural barriers that they face on a daily basis. So what we'll actually be talking about today is pretty applicable. We'll be discussing some of the solutions that local governments can use to reduce financial barriers to make their Solarize-like campaigns more inclusive of low and moderate income residents. So just to take a step back of where we are in this cohort process, the first two workshops focused on developing community partnerships, and after that, with those community partners, developing the goals and roles of the campaign, as well as the structure for the campaign. And today we're going to be focusing again on reducing financial barriers for LMI residents. So we have two desired outcomes today. The first is to understand the available solutions that are out there to reduce LMI financial barriers, and then utilize a worksheet that we've created to prioritize which financial institutions you'd like to partner with and specific LMI solutions that you would like to pursue. And from these two desired outcomes, we developed our agenda for today, which is fairly packed. We'll start with, again, as we've done in the past, an opportunity for each other to meet other cohort participants with a check-in question. I will provide a very quick overview of some of the solutions that will be discussed today. And the first main category for today's workshop is going to be on solar loans for direct ownership. So we'll hear from Carrie O'Neill and Madeline Priest from Inclusive Prosperity Capital to speak to their national Smarty loan platform. And we'll hear a recording from Blake Jones from Clean Energy Credit Union on their solar loan offering. Unfortunately, he was not able to make it today, but did record something that we will be able to play. And we'll have some additional insights from other experts in this field with some Q&A right after that. And then the other main topic that we'll be discussing today is how to further subsidize the costs for LMI residents and address some of their credit barriers. So Tushar will talk about some of the tiered pricing options in a Solarize campaign, and chat with Solar United Neighbors and Solar Crowdsource about their experience buying down the cost of solar for LMI residents in their Solarize and solar co-op campaigns. And lastly, we'll hear from Lauren Levine from Solstice, who will be talking about their EnergyScore FICO score alternative. And we'll have about 20 minutes, hopefully, for breakout exercises for each community to work on a worksheet to work through some of these questions. And then I'll finish up with just some next steps looking forward for this cohort. So this will be pretty quick. I just wanted to kind of set the stage for some of the solutions that are going to be discussed today. So really, when we were thinking about these Solarize campaigns or Solarize-like campaigns like solar co-ops, in order to enable LMI homeowners participation, they really need to address some of the financial obstacles that they face. So these include limited capital, so having a limited amount of capital to spend on an expensive solar PV project. So what that looks like as a solution level is making sure that LMI homeowners can purchase solar at $0 upfront so that it does not affect their limited capital. They also have limited flexible spending. So the solar PV system should provide immediate cost savings. So not eating into that flexible spending that they have, but rather expanding that flexible spending, so resulting in immediate cost savings. They also have other financial priorities. So this gets back to this theme of immediate cost savings to be able to really incentivize these homeowners for this to be a worthwhile endeavor, because it will result in immediate cost savings. And this framework of enabling solar for LMI homeowners at $0 upfront with immediate cost savings is the framework that we're going to be using today, and the solutions that we're going to be using to try to get to that point. So solar loans and third-party ownership are two of the primary mechanisms to enable solar installations at that $0 upfront cost. So solar loans being where the homeowner directly owns the solar PV system and pays it off over time through a loan. For third-party solar owned systems, that's where the installer will own the system and the homeowner will pay for either the power produced over time with a power purchase agreement or PPA, or pay for the solar equipment over time in a solar lease agreement. And there are some quick pros and cons and advantages to these. For solar loans, this typically enables the homeowner to really realize the maximum lifetime energy cost savings. So over the lifetime, this is going to result in the most cost savings, typically. It can also typically increase the property value. For third-party owned systems, the primary advantage here is removing any of the operation and maintenance responsibilities associated with direct ownership. It also provides an energy contract that may be more easily comparable to their monthly energy bills. So most residents know how much they spend per month on their energy bills, and they can compare that pretty easily to these third-party contracts, especially if it's a power purchase agreement where they're getting a 10 cents per kilowatt hour power purchase agreement, for example, and they can compare that to their residential rate that they currently have. The last thing I'll quickly note here is that for some low and moderate income residents that don't have enough tax liability to take advantage of things like the federal investment tax credit, third-party ownership can be a solution to at least pass down some of those benefits when the third-party owner takes those tax benefits and passes some of those down. For the immediate cost savings side of the coin here, solar loans and third-party ownership can provide immediate cost savings in some situations, but it really depends on what additional solutions are included here. So for solar loans, this could look like improving the loan term. So for example, reducing the interest rates. And this could be done through something like a loan loss reserve. And that loan loss reserve could also lower the qualifications, so the FICO score requirements or debt to income requirements. And Inclusive Prosperity Capital will actually be speaking to that later on the loan loss reserve. On the third-party ownership side of things here, lowering qualifications could look like rewarding installers in their RFP responses that have lower or alternative FICO score requirements. So having that in the selection criteria of the RFP. And Lauren will speak to that, to the EnergyScore alternative later today. And lastly, just the option to lower the actual cost for LMI solar, the cost of solar for LMI residents. And this could look like buying down the cost through funds that are acquired, or structuring the pricing so that non-LMI residents use some of their savings to subsidize the cost for LMI residents. And these are the topics we're going to get into today. So I'm not going to really double click on any of the details here, but I wanted to just provide an overview of what we'll be talking about today, as well as noting that it's not a one size fits all thing. And in some cities, they might need multiple solutions to achieve immediate cost savings. For others that already have a lot of incentives, maybe it only looks like one of these solutions. And we'll be utilizing a worksheet to get to that.
Well, thank you everyone for having us here today to talk about one of our financing products that has been used historically in Solarize campaigns in Connecticut as an example. We're going to talk about the Smart U Loan program. My name is Madeline Priest. I'm the Senior Manager of Market Engagement at Inclusive Prosperity Capital. In 2018, Inclusive Prosperity Capital actually was spun out of the Connecticut Green Bank to act as sort of a boundaryless green bank to take our successes that we saw in Connecticut nationwide, really focused on serving traditionally underserved markets and communities. And the Smart U Loan product in particular is designed to really help homeowners, make sure they're navigating the right contractors to engage, identifying the right measures to be financing. It's also bringing together private capital lenders that are already out in this space, doing unsecured personal loans every day, they want to get into this space. They just don't know how to get into green lending. They don't know how to get it started. Just by creating a financing product is not enough. You need assistance in kind of getting it to the market and reaching contractors who are really, and campaigns such as Solarize campaigns, who are really out there kind of promoting products. And the contractors, if they're going to be taking on financing, they need to know that it's a reliable source of funds, especially for bigger jobs such as solar, which maybe have kind of multiple installments and milestones along the way that require working capital to be successful. And kind of anyone who's out trying to promote energy efficiency programs, we know that this is a great way to be a lever in achieving those goals. So our Smart E-Loan program is actually a platform that we've created in partnership with Michigan Saves. We've kind of copied the model after them in Connecticut, and we've taken it nationally. Colorado has also copied Connecticut and Michigan. And so with those 3 programs, we've already seen over $250 million in loans, almost 23,000 households across these 3 states, 16 community-based lenders, over 1,000 contractors in solar, energy efficiency, HVAC, home remodeling, you name it. Anything that's saving customers energy, we have those contractors involved in these programs. And we see excellent performance in terms of repayment on these loans for customers. And really the idea of these loan programs is that by creating this online platform, it's standardized across the board, and you're really taking advantage of existing lending capacity of local community-based lenders, local contractors who already know how to do this work. And then you're able to just really be focused on kind of leveraging those expertises. So the product itself is an unsecured personal loan for homeowners. 1 to 4 units is considered single family. It needs to be owner occupied. And it's low interest financing, anywhere from 5 to 20 years, with a term or a rate of 4.49 to 6.99. And it's designed to be really easy application through local lenders. There's no application fee for the customer, and there's no customer down payment required, which makes this a good ownership option for any low-income homeowner who would like to own instead of lease or do the power purchase agreement. And additionally, homeowners can include more than just solar into these loans. So I know it's a Solarize campaign, but sometimes people get really excited about energy efficiency after doing solar, and this is an opportunity for them to incorporate a more whole home approach into their home energy plan. Customers can borrow anywhere from $500 to $40,000, and they can take 25% of the total loan amount, and they can apply that to structural remediation. Let's say the roof needed reinforcement, electrical upgrades, that can all be rolled into the cost of the loan. So that way the homeowner really truly has no down payment required, no upfront capital is required to do this work with the Smart E-Loan. That being said, as I mentioned before, contractors need to know that they're getting those reliable funds. So the nature of this loan product does allow the contractor to receive 1/3 of funds upfront before the work begins, and a final 2/3 upon proof of completion of the work. It's a really easy program to get qualified into. So the contractors just have to provide proof of being properly registered and insured to do the work and licensed to do the work in their state. We generally ask that they have no negative Better Business Bureau rating. Then they participate in a training on how to use the online platform. It's very, very straightforward. And then that they just maintain good quality in communicating with their financing, with the paperwork via the platform, and maintain quality installation and quality work. The customer themselves, a borrower, it's a 580 FICO score or higher, with debt to income not to exceed 50%, and no bankruptcies in the last 5 years. And that's assuming that the lenders are on what we call the credit challenge term sheet. The majority of credit unions, for example, are on this term sheet. And then the work itself, as I mentioned, it needs to be done by an approved contractor, and it needs to be in an owner-occupied single-family home. And the thing is with this, you don't have to reinvent the wheel. IPC, along with our partners at Michigan Saves, we've solved all of these hard problems already. We know how to help support contractor engagement and running campaigns around this and to help add this to your Solarize campaign. We know how to bring in the right lenders to this platform and this offer kind of long-term past your campaigns. And we really know how to scale and drive volume in hard to reach communities. As I mentioned, just creating the loan product itself isn't enough. You need to know how to reach the people who can really benefit from the product and how to utilize existing programs that already exist. So Clean Energy Credit Union is a great example. You'll hear from Blake in a moment. Or the Smarty Loan program. You don't have to create it from scratch. These things already exist, and we can help connect you to the right resources for your program and your community. And as was mentioned earlier, it really, for a Solarize campaign, from my experience, it really should kind of a multiple options for your homeowners. And by utilizing kind of this platform already that exists, you're able to take advantage of kind of workflows and our creating efficiencies through our engine platform, which is kind of a standardized work management workflow tool. And we really have figured out which energy measures are going to be saving customers money in the long run. And so customers aren't going to be financing things that aren't going to allow them to be saving money and therefore be paying back their loan. As I mentioned, the engine platform is really kind of the house for all of the moving parts on this loan product to sit online where we can all communicate and create transparency on each individual project and keep every homeowner moving so that way people don't get lost between the cracks. Homeowners don't have to constantly be advocating to themselves, to their lenders, to the program, to their contractors. A lot of that is happening really seamlessly behind the scenes with the engine platform. I'm going to pass it off to Carrie O'Neill.
Hi, everybody. Great to see you this afternoon. So I'm just going to spend 2 minutes, if you could go back one slide, Madeline. Yeah. On loan loss reserve design, and we use a loan loss reserve in our program and product. And so the purpose of the loan loss reserve is to credit enhance for lenders who are new to the green energy lending space to get them into this new type of lending. It also serves the purpose of getting them to offer lower rates for unsecured loans, not the rate that you would go in and get as on a personal loan product. And Madeline had showed those rates. It offers also a tool to go out longer in terms of maturity. Typically, unsecured loans are like 3 to 5 years in maturity. We can go out as long as 12, 15, 20 years, depending on the lender. And then more generous underwriting criteria so you can serve more of the market. And last, to offer a higher loan amount. So loan loss reserves are really powerful as a tool to engage your local lenders. If you go to the next slide, there are some other things that you want to think about when you design your loan loss reserve. First of all, how big is it going to be? And that really is dependent on how much budget you have and the source of your funding. So sometimes you have to work backwards from that. The loss position is another consideration. Are you going to be a first loss or a second loss? What position are you taking? What's your coverage ratio? So how much is that loss reserve account growing as loans are originated? And then, what percent of the losses are being covered? Is it 90% of a loan for a first loss design, or 100% of the portfolio in a second loss up to a certain maximum? And then the last is, how long is it going to be available? Is it forever? Forever's a long time, or is it for a short period of time? So if you go to the next slide, just really quickly, I'm going to answer these questions for Smarty and how we handle it. We use this as a second loss where the lender is responsible for the first 1.5% of portfolio losses. And the point here is to align. Lenders are in the business of lending. They expect some losses. So as a program, as a government, we're only going to cover losses above and beyond what we call an expected loss rate. And we set that at 1.5%. And so we'll cover 100% of losses above that, up to the value of the loan loss reserve account. And the loan loss reserve account grows by either 7.5% of the amount outstanding or 15% based on whether it's a lower or a higher credit score. And as we think about new program design, we would recommend time bounding. Forever is a long time. We have excellent data on the portfolio performance. We view loss reserves as a way to attract your local lenders into this sort of lending to get them going, but that sort of credit enhancement should not be needed permanently. And I think on the next slide, we have a quick budget, which I won't go into. We'll share these slides. Ryan will make sure you get out, but it does just do the math for a sample 100 loan program. I used a sample loan size, and it gives you a sense of what that budget would be. Some important considerations on the budget. In Connecticut, we've done $70 million of loan originations. We have only paid out about $120,000 in loss reserves, even though the size of the loss reserve is like $3.5 million, something like that. The payout has been very low. So there's this notion of how much your obligation is versus what you actually might cash fund versus what you actually might pay out. Those are all very different numbers. And I'll stop there. Oh yeah, potential funding sources. Yeah, sorry, important. There is this thing called the Community Investment Guarantee Pool. That's something we're thinking about for a national loan loss reserve product, and would love to partner with cities to go in and apply for these funds. You've also got utility ratepayer settlement funds, or if you have your own funding, which often is unusual, but if you do, that's another source of funding.
Hello, everyone. My name is Blake Jones, and I'm a volunteer for Clean Energy Credit Union. Clean Energy Credit Union is an online-only, federally chartered credit union that focuses exclusively on providing loans for clean energy and energy-saving products and services. A credit union, briefly, we provide the exact same products and services as a bank does, and our deposits are federally insured, but credit unions are not-for-profit and tax-exempt cooperatives that are democratically owned and controlled by their members. At Clean Energy Credit Union, we envision a world where everyone can participate in the clean energy movement, and we help to manifest that vision in two ways. One is we make it easier for everyone to afford to use clean energy or to save energy by offering, our goal is to provide the very best loan terms in the country for these types of projects. The other way we bring about this vision is we make it easier for everyone to invest in the clean energy movement. So someone can open a checking account or a savings account at Clean Energy Credit Union. Their deposits are federally insured, but they know that their money is only going towards helping somebody else to finance their clean energy project. Clean Energy Credit Union is unique in this combination of things, not in any one of these, but the combination. The credit union structure, being tax exempt and not having any stockholders, we don't have to pay Uncle Sam, we don't have to pay stockholders, so we can pass through those savings through to our members in the form of better loan terms. By being a cooperative, there's also a cooperative trust factor. It's not the same as with a bank, where a lot of people these days don't trust banks, or at least are skeptical of banks. But we have federally insured deposits the way that all other federally insured depository institutions are. Second, we have a sole focus on clean energy lending. That's all we do. We don't provide any quote unquote normal loans. You can get an auto loan with us, but it has to be for an electric vehicle, for example. You can get a home improvement loan, but it has to be a green home improvement loan. It's in our mission, it's in our DNA. We also have market expertise on the board, on our team. And clean energy markets are very dynamic, they're fast changing, and we can adapt to those changes very rapidly because this is all that we do. Third is that we're online, mobile only. We don't have any brick and mortar branches. And so that overhead savings, this is another way we can pass through those savings to our members in the form of better loan terms. So these combinations of things are what allow us to do what we do and to offer the very best loan terms for clean energy projects. Since we started lending about 2.5 years ago, we've experienced tremendous success. We've made over 2,700 loans, and we haven't had a single delinquency or default. These are all clean energy loans in alignment with our theme and with our mission, and we're experiencing significant demand for them, which is great because it's just proving the concept and the vision that we had for creating a credit union that focuses on what we focus on. The types of loans we make are electric bicycles, electric cars, putting solar panels on your roof or in your yard, geothermal systems, high efficiency heat pumps, HVAC systems, anything that has that energy saving, energy conservation, energy efficiency, clean energy theme, that's the type of loan that we provide. We have partnered with multiple municipalities and state governments to via what we're calling a loan loss reserve partnership. And the sponsor entity, a municipality or state government or some other agency, they will provide loan loss reserve funding in exchange for Clean Energy Credit Union providing better loan terms to their program participants. These are some examples of some of the sponsors that we've worked with, and some of these programs are relatively new. Some are older, but they all have some things in common. And one of those things that they have in common is that the sponsor wants their constituents, in most cases the residents of their geographic area, to be incentivized or to be encouraged to do a green home improvement. And in order to do that, they may be working with local area contractors who do those green home improvements, but they also want to make sure that the program participants can get access to really good financing. So we typically provide a 0.5% rate discount in exchange for the loan loss reserve fund. And these are some of the program variables that we typically see in these programs. It isn't intended to be an exhaustive list, but it gives an idea of some of the primary variables and the others. And the list is much longer than this, depending on what how the sponsor wants to design the program. But this is what takes the most time. Usually when a sponsor reaches out to us and says, hey, we want to do a program, the first goal is to try to pin down as many of these variables as possible and then come to mutually beneficial agreement on the others. It is very, very helpful when the sponsor knows what they want, or at least knows what they want for some of these variables, because then we can, by process of elimination, we can start with those and then work on the others. And then once we've determined all of the variables, a sponsor would work with us to memorialize all that into a legal agreement. And we can use a template from another loan loss reserve program. Usually municipal state entities that we work with are happy to share their agreements, and we can use those as templates, or sometimes a sponsor wants to draft their own agreement or use something that they've already got. But either way, the steps are, if someone wanted to work with Clean Energy Credit Union, reach out to us, start the conversation about these variables, design the program, fix and determine all the variables, and then work on memorializing them into a legal agreement, and then figuring out all the launch details and how it's going to be marketed and next steps from there. I was asked to just provide some terms for our solar PV loans, not the other types of loans. So I'm going to focus on just our solar photovoltaic or solar electric loans, but we do consumer lending only. It can be for retrofits, new construction, or off-grid residences. And in our solar PV loans, we allow for batteries or energy storage, electric vehicle chargers to be included, and also up to $3,500 for some certain types of work that are often required to support or accommodate the solar PV system being installed. We specialize in what's called a combo loan, which is a short-term loan combined with a long-term loan. And the short-term loan is intended to help the customer to float the amount of the tax credit. There's a federal income tax credit of 26% in 2020. It's 22% next year in 2021. And we just want to help float that amount until after the customer files their tax returns or gets a refund. So that loan is usually 12 or 18 months, as low as 4.99%. And then the remainder of the project cost is in a long-term loan that's 12, 15, or 20 years. Our goal is to have the lowest interest rates possible, and we allow for project sizes up to $90,000. And all of our terms can be found on our website at cleanenergycu.org/rates if someone wants more details. We do have some fees. They're very minor, $25 processing fee per loan, so $50 for a combo loan. And then we pass through the cost of a UCC filing. And a UCC filing is whereby we're perfecting our security interest in the project equipment only, like in the solar panels and solar equipment. It is not a lien on the home. And in terms of underwriting, we have some pretty subjective underwriting standards. I think the way I would put it is we can underwrite a lot, very flexibly, a lot of different things. Our goal as a nonprofit credit union, our mission is to try to help people put these solar panels on their roofs. So we can take a look at some unique situations and approve them. Now, if someone's got a FICO score in the low 600s and they've got a DTI in the high, 65%, and they've got bankruptcy 2 years ago, it's going to be very difficult for us to approve that. But I'm on our credit committee, and we've approved some pretty unique situations, and we'll take a look at what the utility bill savings are going to be and how that's going to help the borrower to service the debt. So we've got some flexible underwriting standards, but our online loan application software can instant decision, the parameters that are shown here, FICO score above 680, a DTI less than 41%. Those are a lot easier for us to instant decision or instantly pre-approve. Again, just want to reiterate, only collateral we take is the project equipment. And we do have some borrowers ask, well, if I refinance my mortgage, I don't want the solar system UCC filing to interfere. And the good news is it doesn't. We've done hundreds of these while interest rates are low and people are refinancing their mortgage, and we're batting 1,000 in terms of being able to sign a subordination agreement that the new mortgage company is happy with. So if everyone's interested in learning more, please reach out to me. Again, my name's Blake Jones, and my email address is shown here, but blake.jones@cleanenergycu.org. Thank you.
Okay, and I'm just going to, stop that presentation and make sure that we do a quick time check. We're just a few minutes over our initial agenda, but I did want to make sure, I know that there are a couple other experts in this workshop right now that we didn't have enough time for them to give a full presentation, but I did want to have 7 or 8 minutes to ask a pointed question from Laura from the Philadelphia Energy Authority, Doug from SELF, and Ruta from PosiGen, since they do have experience with solar lending, especially to LMI residents. So I'm going to, I know that Laura has to jump off first, so I'll double check to make sure that that she's on the call right now. But the question that that I'm looking to get just kind of a quick response from you three is, given Inclusive Prosperity Capital's presentation and Clean Energy Credit Union's presentation on these types of loan offerings, what really resonates with you given your experience in LMI solar lending? And is there one additional key insight you would recommend local governments to keep in mind? So that is the question. I'll see if Laura is here, and if so, hey Laura.
Yeah, hi everyone, how are you? Good to be back. I can just chime in briefly. We've really admired IPC's work and looked at them as a model, as well as PosiGen. So Rita, good to see you. We actually looked at PosiGen's data when we were putting together our loan product for our low and moderate income participants in Solarize Philly. And we saw that they had under 0.5% default rate. So that really helped us build the case here to work with a loan servicer in Pennsylvania. Knife is what they're called, and they've been servicing the loans, but in our case there was a interesting setup. Well, they're the National Energy Improvement Fund, just so you have their full name, but they're a Pennsylvania-based lender that has experience with energy lending, and so that low default rate experience from PosiGen helped bring them to the table and have them have comfort, but they're not actually the lender for our program. We have a local community development corporation that's providing the capital towards the loans. So they actually raised funds through grants from local foundations that are being lent to our participating households via Knife. So Knife is the lender that's servicing the loans, but the money is actually coming from a local nonprofit that fundraised them from grants. So you have this innovative partnership going on between a local nonprofit capital provider, which is the first time they've done something like that, and then a lender. And in this case, then, as the homeowners are repaying those loans, then the funds are going back to the nonprofit, and they'll either be cycled into programs at that nonprofit or used towards future versions of our LMI solar program. So that was interesting. And in that case, then the local nonprofit, the CDC here, is the lender. So we needed to have them comfortable with the loan terms and the loss reserve that we are setting aside for this program. And we ended up being really generous with our loan loss reserve. I think, Carrie, we might have put more than we needed to in it, but we wanted to be extra conservative for the first time. And then based on the experience of that, we'll be reducing the amount we're setting aside in the loan loss reserve for future programs and also drawing it down over time. So I think those are my comments initially, but would love to stay in touch with all of your organizations as you're figuring this out. It took us a while to get to this point, and we're right now actually submitting a grant application to the state to get funding to help cover about half of the project cost again for 2021. So it still looks like we need to be subsidizing here in Pennsylvania anyway, about half of the project cost in order so that the loan payment is less than what they were paying previously on their electric bill. That's not counting on them taking advantage of the tax credit though. So that's one note.
Thanks, Laura. Yeah, so you mentioned Ruta at PosiGen, so I'll just pass it over. Ruta, do you have any initial reactions or maybe just like one key additional insight you'd like to note? I know we're a little condensed for time here, but would love maybe some quick insights from you in a minute or two.
Yeah, no, that's perfectly fine. I can put on my motorboat lip to like get to speaking fast, but what the one aspect that I did want to like touch on as far as like our kind of lease packaging for third-party solar leasing is the need for like policy to be in line for, you know, a third-party business to be able to sustain those jobs in that region or in that area. So that's hugely important because the benefits that a lease program offers are maintenance and liability, homeowners insurance, and affordable payments for the energy that gets used by the customer on site. Some of the other like aspects around that are from PosiGen's perspective, we're willing to work with any and everybody to increase the amount of renewable energy or sustainable energy in a region to promote its use. But those were some of the larger aspects that I guess I'd be willing to contribute or kind of talk about, because when people start talking about kind of financing or numbers, I want to say my entire job exists in person, and I know that lots of other people's jobs exist on spreadsheets, and I fully appreciate them. But if there are ways to collaborate with other organizations, we're all ears on figuring out how to do that.
Lastly, and then, yeah, lastly, Doug Howard from the Solar and I think I have that right, Solar and Energy Loan Fund. Yeah, interested in your perspective as well with all of the great work that you've done in Florida to date.
Great, thank you, Ryan. We're a nonprofit, and we're also certified as a community development financial institution. So as a CDFI, we have a laser focus on trying to help LMI homeowners. In fact, 73% of all of our lending to date has been in LMI census tracts. So much like IPC, we do a more comprehensive financing of all sustainable building practices. And ideally, we want to get a homeowner to the stage where they're ready for solar. But many of the things that were just talked about resonate with me, but I would just highlight a couple really quickly. When we're going in and trying to work in LMI communities, the condition of the homes is typically a vital issue that needs to be addressed before the home is ready for solar. It doesn't make sense to put an expensive solar system on a house that has no insulation and a 20-year-old air conditioning that's chewing up energy. You got to start with the quick, more cost-effective fixes first, and then move your way towards solar. I think the other key issue is the inclusive financing aspect. There's many people that don't have 680 credit scores, and they've had one incident in their life or another, whether it's a divorce, a death in the family, a medical issue that's caused their credit scores to drop, but that doesn't mean they don't have the ability to pay. And so our nonprofit does not make a decision on a loan based on FICO scores. We are looking specifically at the homeowner's ability to pay and then determining what disposable income they have. and building a loan around their ability to pay. So we're even able to help people have 0 credit scores or sub 680 credit scores or whatever it may be. The other key thing is IPC mentioned that typically the unsecured loans are 3 to 5 year terms, and that's true for us as well. And we raise money from banks, faith-based organizations, crowdfunding, and so forth. The most challenging thing is to come up with the longer term financing, which helps achieve the broader goal that you're all talking about of trying to make the loan payments comparable or less than the cost of energy. And oftentimes the term of that loan is critical. And then lastly, I know I don't have much time here, but I think you also need to specifically design a product that an LMI homeowner is more likely to be able to afford. In other words, you may not want to be shooting for net zero in a 10 to 15 kW system in all cases. There may be smaller homes that a 5 kW system would be a really good start. Don't preclude those folks. In fact, specifically design a product where they could take that first step and maybe begin with a smaller system and work their way up towards net zero. So those are just some initial thoughts that I had as I was listening.
Thanks, Doug. Yeah, and I know that with Laura's experience specifically in Philadelphia, Doug's experience most specifically in Florida, and then Ruta's experience in the states that they work in as well, and particularly in New Orleans, all have different perspectives here, and I'm glad that they were all able to share, but I, of course, wish we had more time for them to expand more. But we do have maybe a few minutes for any follow-up questions that anyone would like to ask that hasn't been answered in the chat yet. So I will open it up to any questions, either for Carrie or Madeline from IPC, or from Doug and Ruta, given what they just said.
One question I have, this is Christopher from Salt Lake City. Some of the folks talked about having like a national platform, but then also working with local organizations. Could somebody just chat a little bit about how that national to local interface happens?
I can talk about that. The Smarty loan program is, we think of it as a national platform in this way. Instead of every local credit union, community bank, CDFI, who we want to get engaged in green lending, having to reinvent the wheel, what we've done across the states we've operated in is standardized an approach to what a loan product needs to look like, standardize an approach to a loss reserve, standardize approach to contractor vetting and managing the pipeline and plugging into campaigns like Solarize or Weatherize or Energize, or, there are all kinds of ISEs out there. And so it's really meant, like we're on a mission to teach local lenders all across this country to get engaged in climate finance and clean energy lending. Now, those of you in Southwest Florida are really lucky. You have SELF, like they are amazing. And so that's fantastic. And they're expanding throughout the Southeast. But there are all kinds of parts of our country that don't have enough local lenders who are serving their local communities with these sorts of products. So that's what we're here to do. We're here to take these learnings and drive them right down into communities so that the local lenders in those communities can get engaged in lending safely without having to become energy experts, because I don't think that's realistic. That's like maybe someday, but it's going to take a lot of time, and we don't have a lot of time. The climate crisis is here now and urgent, and we don't want anyone to be left behind. We don't want low income and underserved neighborhoods to be left behind.
Thank you.
This is Bobby from Minnesota. So this was awesome. I got to say, I think I understood half of it, so I probably only understood 25% of it. But it's important. To make the Smarty loan work or the similar programs, what you need then is a willing bank and an entity to put up the loan loss reserve. And is that right? And what I don't know is that money you put up for the loan loss reserve, if you get a local government to put it up, is it in a black box, or can it be used for other stuff as long as it's fungible to tap? How does that work?
Yeah, no, any lender, if Blake were here, he would tell you that, or Doug could as well. Any lender is going to require that that money is set aside, it's reserved, it's for the purpose stated. Now, it's very unlikely that it'll be all spent, like really unlikely.
Yeah.
And so down the road, when you don't need that reserve anymore, that money can come back to the funder, to the city or the county or whoever. But yeah, it does need to be reserved. A lender's not going to just say, yeah, we trust you. They're gonna want to see that it's reserved.
And is it an interest accruing account or?
It can be, and yeah, it can be. I mean, nobody's earning a lot of interest, but yeah.
Hello, this is Rob. I have a question for Carrie. Carrie, you stated that you've lent, that your foundation has lent over 70 million, and your reserves, you've only used a little over 100,000. What do you attribute those good results to?
Yeah, so that's the experience of the Connecticut Green Bank, the state of Connecticut, their version of this program. That's due to two things. First of all, the design of the loss reserve is that the lenders take the first loss. They're in the business of credit unions are in the business of lending. They expect losses when they do consumer lending. So we put them on the hook for the first 1.5% of losses, which we can negotiate that. That could be a negotiated item, but we felt that was fair given unsecured personal lending and what they would expect. So losses above 1.5%, they can come to us. So they're protected against excess loss, beyond business as usual loss. And so that's why the payouts have been so low, is because the loss rates are below 1.5% by and large, except in some cases. And yeah, that's so really kind of smart design, aligning the interests when you design a loss reserve. When you're working with private partners, understanding they're in the business, so let them be in their business. We're trying to get them into a new business. So design of the loss reserve is critical.
Thank you.
We've heard from Madeline and Carrie and Blake about different loan products. Financing is definitely a crucial piece of the puzzle, but it's unlikely that financing a loan will lead to a no money down immediate cost saving solution. So in the absence of specific LMI policy incentives, most campaigns will likely need to look into subsidizing the costs of LMI solar installations, which can allow for better loan terms and lower monthly payments. So perhaps the most straightforward way to do this is to simply help buy down the cost of a solar installation. Buying down the cost is as simple as it sounds, using some source of funding, whether that's program or grant funds, to purchase a portion of the cost for LMI residents, which is in addition to the Solarize group discount. So we've seen campaigns find funding for this through a few different sources. We've seen communities work successfully with local foundations and philanthropies. Crowdfunding is another way that campaigns can build a small amount of funding. And I'm sure Don Moreland at Solar Crowdsource can speak more to this in detail. We'll be hearing more about buying down the cost from Don and from Jasenia at Solar United Neighbors shortly. But before we hear from them, I also wanted to talk about maybe a more innovative or bootstrapped approach, which is how campaigns could potentially use a differential pricing structure to further subsidize LMI installations by distributing the bulk of the Solarize savings to LMI residents as opposed to distributing them equally across the group. So in this approach, Solarize programs will basically ensure that LMI residents receive the bulk of the Solarize group discount. We had Laura Rigel explain how Philadelphia Energy Authority has done this in a way in the first workshop by charging a flat 25 cents per watt fee for all program participants. So because of that, their group discount, that 25, that fee at low income. I think my internet's unstable as it's happening.
Yeah, Tushar, if you want to turn off your video, maybe that'll help if your audio is having some trouble.
Okay. I think when you're sharing your screen, I'm not actually sure where the turn off video is. Okay. Do you see my video? Is my video off now?
Yes. Yeah,
Okay.
You're good to go now.
Great. So yeah, so basically that Philadelphia Energy Authority's 25 cents per watt fee was a way of distributing that cost. So one other way you could do this is by working with the installer to kind of have that differential rate structure for LMI and non-LMI customers within the just within the rates that the installer offers. So I'll give it a hypothetical example of how this could work. In a typical Solarize-like campaign, you'd have, say, a market rate of $3 a watt, and then you might get an offer from an installer for different levels of discount based on the number of people that sign up for the program. In this kind of differential cost model that we're showing here, you could have a similar thing. However, the installer would offer a different cost for the installation based on whether the customer is in the lower moderate income bracket or not. So in this example here, you can see, for example, that in the last tier, if the Solarize campaign has more than 25 contracts, non-LMI customers still see a saving, but LMI customers see a much greater 25% saving, as opposed to distributing that savings equally and having all customers see a 17% saving. So that, in a sense, is like a 50% greater saving for LMI residents. And with that, we will move on to a kind of virtual fireside chat with Yesenia Rivera at Solar United Neighbors and Don Moreland from Solar Crowdsource. Both of these organizations have run a number of Solarize or solar co-op programs, and they've have experience buying down or subsidizing LMI solar installations as part of those campaigns. So Yesenia and Don, are you both ready?
Ready.
Yes, thank you.
Great. Okay, so maybe to start, in about 60 seconds each or so, could you both introduce yourselves and very briefly describe the way in which the programs you've been involved in, which you've bought down the solar installations for LMI residents? Maybe Yesenia, if you could go first, and then Don next.
Sure, Yesenia Rivera. Tushar said I'm the Director of Energy Equity and Inclusion for Solar United Neighbors. So we've tried a different number of pilots to buy down or subsidize LMI solar, from government grants, philanthropy, and the one pilot that we're about to launch, or hope to launch early next year in Minnesota, is working with a foundation and a community land trust to buy down a loan and make sure that the customers that do take the solar loan are cash positive from day one. So the loan is not adding to their debt, but they're solar homeowners.
Cool. Don, you can go next.
Yeah, sure. My name is Don Moreland, founder of Solar Crowdsource, which is a platform to facilitate Solarize programs. And then we have a fully functional crowdfunding component to it as well. Two different things we've done. One is, for each of our programs, we have what we call a community project. And this is where the selected installer from the RFP and Solar Crowdsource will donate a portion of the revenues from the campaign to a nonprofit project. Increasingly, the last 3 programs we've had, we have made sure that we direct those funds toward a nonprofit that provides affordable housing for LMI families. And what we're seeking to do is reduce the energy burden for those families. And so out of that, we're able to reach, 3, maybe 4 families from that philanthropic effort. And the other one is we have a program going on in St. Thomas, Virgin Islands of all places, where the energy burden is very, very high, some of the most expensive electricity in the world. And so there's a great need there. And we have been fortunate enough to receive a donation of $50,000 to go towards buying down the cost for LMI families. But that is restricted. It's got to be a matching fund. So we should hear soon. We've applied for a few grants, and to find those matching funds to turn that into a $100,000 fund to help buy down the cost, and then we'll plug in our crowdfunding part of the program as well. So any individuals, even if they're not participating in the Solarize program, will have an opportunity to give, and they'll get a tax deduction in return.
Cool. So yeah, thanks for those program descriptions. I guess my next question, and given our timing, this may be our last, but we might have a little time for one more. So maybe aim for like 2 minutes each here. Is like, if you're working with a city that's running an LMI focused program for the first time and has a limited amount of funding, how would you decide how to incorporate that funding within your campaigns to access LMI communities? How would you choose what mechanism, and like the balance between how many installations, LMI installations you want to target, how much you want to buy down, et cetera? Maybe just any of you could go first.
Yeah, I would look at the community first. What kind of housing are we working with? Are these houses that may be okay and don't need roof repairs or energy efficiency, so we can just focus on solar? Or is this a community that has access to solar loans already, and we just need to buy down the loans so we're not increasing their debt? Or is this a community where they don't have access to traditional lending, and you may need to do a loan reserve to help them access those loans and be able to go solar? So I think that is the biggest driver in this entire process, is like, who are you working with, and what are your goals? Are your goals to help as many people as possible? Or do you want to just show proof of concept and try to work the kinks out as you go with the program?
Yeah, Yesenia's she's right on. It's a question, do you want to go deep or wide, right? Do you want to buy down the cost of solar for a few homeowners, or do you want to try to buy down, some of the cost for more homeowners? And so for us, it's all about finding that seed donation. You've heard of seed capital for startups and stuff. This is kind of a seed donation to start up your LMI fund, and leverage that as much as possible, because once you have that, then it's possible to leverage a matching grant fund. And then if you can find a credit facility like Clean Energy Credit Union or SELF or Inclusive Prosperity Capital to help you develop a fund that can help stretch the donated funds out farther, then you can have even wider of an impact. So it's all about that first kind of seed donation, and trying to leverage that to make it grow, and therefore you can affect as many families as possible. One other thing I might add is that if your community already hasn't done a energy burden study, there are resources out there, and even RMI has, can point you in the right direction perhaps. But if you can identify those areas of your city or your community that have the highest energy burden, then it'll help you be more intentional on being able to find community partners in that area, and also being able to make the largest impact as well. So that's something that we'll incorporate with our programs from now on. And a lot of times the cities already have that research already done.
Great. Well, I think we have like a minute left. So maybe if we can do like one, if each of you have, you know, just maybe one additional insight for everyone on the call. Maybe if you want to speak to, you know, how you do the fundraising or structuring the program. I know, like, just I know you've always talked. I've heard you talk about, you know, starting small. Any like key insight that you want to share with everyone?
Yeah, two things. Like you said, start small. The larger this project, the more ambitious it is, the more room for error, and it's just going to hold you back, and it's just going to kill enthusiasm, and you're going to have to go back to the drawing board. So maybe start small, see what's working, what's not working, and go back to the drawing board. It's a lot easier than try to do 100, 200 homes and not do anything in the end because it's not working. And the second thing is, no matter what type of program you offer, it's not going to work unless you have community buy-in. You have to meet with the community. You have to get their input. You can't just go to them with, oh, this is what we're offering, take it or leave it, because you're not going to get any buy-in. And just offering free solar is not enough to get them on board. On the contrary, it's like we've noticed that when we say free solar, low-income communities, frontline communities are very hesitant because they've heard these stories before and they've been scammed. So get community buy-in, work with organizations that already have the community's trust. It will make your life easier.
Yeah, I don't have a lot to add to that. If was that the same question?
Yeah, Don, if you, I mean, that's fine if you don't have much to add, or maybe 30 seconds if you do.
Well, it is the community. You know, with the community-based Solarize program, you just have more resources upon which you can look to help develop an LMI program. I think if you're looking for funds for an LMI program, the more community buy-in with the Solarize program itself will lend a lot of credibility. You have more resources available to you, and you'll be more successful with putting an LMI program together.
Well, thank you, everyone. Great to be here, and thank you so much for the effort that you are putting into expanding solar throughout the country. I'm the executive director of Solstice. We are a nonprofit that is working to expand access to clean energy throughout the United States to low to moderate income households and environmental justice communities. And so today I will talk to you about the EnergyScore, which is an alternative qualification metric to expand access to clean energy to LMI households. So as you're probably familiar with, low to moderate income households are disproportionately affected by the negative effects of climate change, pollution, and extreme weather. LMI households also pay a larger portion of their income on electricity, the energy burden that you were just hearing about, and are also systemically locked out of the benefits of clean energy. So there are a number of obstacles to going solar. For the most simplest, roof problems, right? People's roofs can be too shaded, facing the wrong direction, or too old. Also, you just went through a lot of financing conversation. The upfront cost of it is prohibitive for many people. But even when there's a financing option available to households, a lot of the time the FICO score requirements for receiving that household financing are prohibitive at, starting at 650, 680, 700 plus. And what we know about the market of the US is that 51% of consumers have subprime credit scores or are unscored. So right there, we're locking out hundreds of millions of Americans from participating based off of their credit scores. And like most things in this country, there's patterns to who gets locked out. If you look at it by income, disproportionately people who are invisible or unscored are, low income or moderate income. And by race, it's disproportionately Black and Hispanic populations that are invisible or unscored. So Solstice was looking at what the barriers are across the board to residential solar participation, saw this FICO barrier as one of the major barriers that was blocking most households, and decided to use data science to try to come up with an alternative. And that's how we developed the EnergyScore. So we started by collecting more than 800,000 records of account level financial data, including credit scores, utility performance history, and more. So for more than 800,000 people, we had thousands of data points per person. And then we worked with data scientists at MIT and Stanford to deploy machine learning. And through this machine learning technology, we developed an algorithm that, simply put, predicts how likely someone is to pay their utility bill. So if you've ever used FICO score, which everyone inevitably has, you know that it's really a catch-all qualification metric that's supposed to predict our payment on everything ranging from our credit cards to our student loans and now to our solar arrays. But alternatively, EnergyScore very specifically predicts how likely someone is to pay their utility bill. So really ignoring all those other use cases for FICO score, we only care about payment performance on a utility bill. And then we compared what it would look like to use EnergyScore instead of FICO scores specifically for residential clean energy decision making. And what we found is that the EnergyScore is more accurate than FICO scores at predicting whether or not somebody's going to default on their utility bill. And more importantly for us, it is also more inclusive of LMI households. So we can get deep on the data here if anyone's really curious to look at the numbers. We also have plenty more data and information that I'm happy to share with you outside of this meeting. But the high level takeaway was that the accuracy is really improved, especially when you're looking at a definition of delinquency as 90 or more days. And the inclusion also increases at different levels depending on whether the FICO cutoff would have been 650 versus 680 versus 700, because those are the different qualification levels that we tend to see across solar projects for across the US. So how this relates to you is that local governments have the opportunity to pilot the EnergyScore as part of their campaign. So the way you would do that is by including EnergyScore as part of the selection criteria in your Solarize RFP process. And I know this is very high level, which is why my contact information is here. And I can go in a lot more detail about how it would actually work and how it's been used and what it would mean for households in your community gaining access to solar.
Awesome. Thank you, Lauren. So we have about 7 minutes or so for questions. So if anyone has questions for Lauren or Jasenia or Dawn, feel free to unmute yourself or post in the chat box and we'll be monitoring that.
While people are thinking about questions, I'll just add that the next workshop where we're going to be focusing on developing the RFP is where we'll speak to that selection criteria and how you can kind of integrate alternatives to FICO score in the selection criteria.
Ryan, do we just lift our hands or speak for a question?
Yeah, either through the chat box or feel free to just verbally ask your question. So go for it, yeah.
Okay, thank you. Hi, Lauren, this is Duan Andrade. I'm with the Solar and Energy Loan Fund. I'm very, very intrigued by this. I had heard about it. Right now, listening to you, I was wondering if this energy score is directly related or correlates with the energy bill. Like, is there a link to on-bill payment versus off-bill payment? Is it giving us a better probability of non-default on solar that is going to be collected or part of the energy bill? Or, I would like a little more specific information on that.
Sure. So the use case is really up to the user. What we can guarantee is that we'll predict how likely it is that somebody pays. When you're talking about on-bill financing, that's different than your typical utility bill performance, because that is the utility bill. So
Right.
it would predict really how likely someone is to pay that total bill, not necessarily just the solar component of their on-bill financing, if that makes sense. So it is deployable in both an on-bill financing situation or not. Really, the use case we developed it for is when you're taking on the risk of deciding whether or not somebody should be able to participate in your program. This will help you more accurately quantify that risk of the individual, at least much better than FICO scores. Of course, I always like to add, the most inclusive thing that you could possibly do would be to not have a requirement. And we're always in favor of that above anything else. If whoever's taking on the risk of your financing is willing to have no qualification is the way to go. If they want some sort of risk protection via a data metric, then using EnergyScore would be more inclusive than using FICO scores.
So it applies to unsecured lending as well.
Yes.
Okay, excellent. Thank you. We do our lending based on ability to repay. We do pull credit, but we don't base our decision on credit score. So I think this would be, I'm going to follow up with you. Thank you. This would be great to look at.
Great.
I'd like to ask a question if we have time.
Yeah, for sure.
So one of the presenters, I think, mentioned that it takes some time to set up these programs. So I wanted to get a perspective maybe from some of the presenters, like how long does it take? Of course, it varies on the type of program, but just to get a general idea.
It really depends on whether you already have the funding source, because just setting that up is going to take you a while. Once you have that funding source, or while you're working towards it, you can start setting all the pieces like income verification if that's part of what you're doing. So it may take you a while. I know in DC, the Solar for All program, it took almost a year after the law had been passed to figure out all of the details before we actually started recruiting folks for the program.
Okay. And did you have your funding in place, or that was including the time to get the funding in place?
No, the funding was determined by the law.
Okay.
It's financed through penalties for the utilities that don't meet the solar carve out. The problem is that the law said you need to help low income families. This is where you're getting the money from, 50% offset, but that was it. There is no other guideline in the law. So it took the Department of Energy about a year to set up the process on how they were going to administer the program.
Looks like Yargis asked about whether for the national programs, whether they're available in all 50 states.
Yeah, I don't know if, I think that Carrie and Madeline might have hopped off, and since Blake could make it today, I know he can't speak to that, but the reason that we had them present is because they were nationally available to all participants in this cohort. So those should be opportunities for any participant in this cohort.
This is Melissa Malcolm-Baber from Self-Help Credit Union. I'm wondering if some of the folks who have had experience during the last recession with the various Better Buildings challenges and the lending efforts there, are there folks on the phone who have that experience and can speak to lessons learned from those loan loss reserves and efforts to work with lenders compared to what we've learned since then and these much more sophisticated tools that we heard about today?
Hi, this is Andrew Grigsby and with Veridian in Richmond, Virginia. Previously, I worked with an organization, LEAP, in Charlottesville, where we managed a loan loss reserve fund. And it sat mostly dormant for 5 years. And finally, just maybe 2-3 years ago, we finally started seeing interest. So or after I left, but I've heard that since it's gotten some interest, but you know, it's sort of a limited, because it didn't provide a huge benefit to people. You know, it didn't make it more affordable for the buyer. It just made it less, well, I mean, I guess it brought their interest rate down because it made it more attractive to the lender, but it wasn't a huge driver for us as far as getting into the LMI community.
So in the last 2 minutes, I'm just going to talk about some next steps for this cohort specifically. So for this worksheet, we definitely want each community to finish their worksheet and use the resources on our cohort website that's listed here and that will be included in my follow-up email that has all of the content written out from the first 3 workshops, so you don't have to memorize everything, as well as the workshop recordings. Second, we're going to be offering office hours in a 2-week span after Thanksgiving to help answer any outstanding questions from the first few workshops, start relationships with anyone you'd like to connect with, things like that. So we definitely like to have a quick one-on-one conversation with each community, as well as a one-on-one meeting with your permitting staff, because the solar app portion of this cohort will be starting in late January 2021. So we'd like to have just a short meeting, if you could pull in your permitting staff for that, so we can quickly explain that portion of the cohort, what they can expect, just to make sure that they're bought into attending those sessions. A few other things that I'll include in my follow-up email is that we are developing a campaign progress tracker for each community to just put kind of like a green, yellow, red color on different status updates so that we have some visibility into where you might need assistance, as well as you can see visibility into other communities' campaigns as well. We'd love some feedback. We're a couple workshops in and we'd love to know how we can improve the workshops. So in that email, I'll also have just a short questionnaire that you can fill out. And the very last thing for today is to RSVP for the next workshop, December 16th, where we'll be focusing on developing the RFP. That's it for me. I think we're right at the hour. So thank you everyone for attending, and the speakers that are still on for presenting. Our team will stay on for about another half hour or so to answer any remaining questions. But with that, I'd like to just say thank you all for attending.